I wanted to say good morning, but I guess it's good afternoon by now. Just give it one more second for people to join us. Bonjour à tous et bienvenue. So I think we're good to go. I'm looking at the back. We're good to go, or yeah, good to go. Well then, hello everyone, and welcome to this this panel. We're running late, so I'm hoping that we can give you some more energy before we go to lunch. My name is Daphne Pitt. I'm the Deputy Manager of the GET.invest Finance Catalyst. And I'm here today with a very exciting panel. And we hope to be telling you a bit more about de-risking access to commercial finance for the DRE private sector in emerging markets. We'll be talking about the lessons learned, but also about how to bring it forward. And to do that, I have here first Per van Swaay. And Per has a very long title. It's the Senior Vice President of Structuring and Sales for TCX Fund. Then we have, I'm going Virginia Blanco, and you're the Financial Analyst Partnerships for the Development Division of COFIDES. Welcome. Then next is João Duarte Cunha, the Division Manager Renewable Energy for the African Development Bank. Next in line, we have Stephen Fleurus, CFO for ENGIE Energy Access. We have Kisa Giebink from Okra Solar, the Project Financial and Business Development Department. And last but not least, we have Nico, Tyabji, Head of Strategic Partnerships of SunFunder. So welcome all. It's very good to have you in this panel. And I think what we've heard today and what we all know is that indeed to scale up the renewable energy sector in the way we wanted, it is very, very important to have ever more commercial finance. And I think this is a theme we have been talking about for the past few years. So we're going to make it a bit exciting for today, but before we do that, we'll start with some general introductions and setting the scene a bit from our panelists. So I'll ask each and every one of you to give an introduction of your company, the organization, and tell a bit of the lessons learned and the challenges that you see ahead, so that we have a nice context to start the discussion afterwards. And I'll just go from right to left, and then we'll take it from there. Per.
Okay. Thank you. It does work, right? Yes, it does. Brief introduction or also immediately lessons learned?
Both.
Okay, I'll start with a little bit of a brief introduction. So my name is Per. I'm part of a TCX fund. I've seen many familiar faces, and many of you know what TCX fund is. But in essence, we are a development finance institution created by European governments, donors, and all the major development finance institutions globally. We have one purpose in life, and that is to provide currency derivatives in all the markets where commercial banks do not do this. More importantly, what it does through the relationships that we have with all the international lenders. It means that every lender, if it chooses to do so, and if it's has the setup to do it, can, using our product, lend in local currency, in any currency globally, and focusing on Africa, in every sub-Saharan African currency. So all development, all impact lenders once they have organized themselves and set up with us, they can lend for any tenor and any volume in any African currency. And I think that's the key message that needs to be repeated and repeated and repeated over and over, because it is still, I think, for many businesses, but also for the lenders themselves sometimes, but also certainly for corporates and businesses in the countries that are looking at financing options, it's counterintuitive when you're talking to an international lender that you can borrow in your own local currency from that lender. But that is the case. It's just the fact that those loans, it's technical, they're synthetic, you're not actually dispersing in the local currency, but from a risk point of view, these loans are local currency. So that's the key message that I wanted to kick off with, and that will we keep continuing infinitely perhaps, but all international lenders can lend in any African currency for any required tenor and any required volume. There's many issues around that still, many lessons that we've learned. You know, why is it not being taken up by everybody? What are the issues around price? And I think that pricing of local currency debt is an issue that needs to be considered. And we are also addressing that issue. I don't know if there's room to talk about that now, or maybe we can leave that for the next round and hand over to the colleagues first.
Let's hand over to the colleagues first. Thanks, Per.
So, hi everyone. My name is Virginia Blanco. I work for COFIDES. For those of you who may not... Hi, can you hear me? Okay, perfect. So, hi everyone. My name is Virginia Blanco. I work for COFIDES, which is a state-owned trading company in Spain. And regarding our activity, we have two main missions. The first one is to promote the internationalization of the Spanish company and the Spanish economy. And the second one is to contribute to the sustainable development of emerging countries. So in order to fulfill this goal, COFIDES supports AFIP, which is the Spanish Cooperation Agency, in the management of FONPRODE Fund. FONPRODE gives reimbursable financing to projects that seek to promote human development. So in addition to that, COFIDES is one of the accredited companies for the delegated management of the European Union budget. And this means that COFIDES can present and manage what we call the blending facilities. A blending facility is a combination of the resources of the European Union, usually grants and guarantees, with the reimbursable funds of the Spanish Cooperation Agency. And that is why I am here today, because in the framework of these facilities, we have managed to implement one of these programs, which is called the Renewable Energy Program for Sub-Saharan Africa. And this program supports off-grid and mini-grid renewable energy projects to improve access to energy in Sub-Saharan Africa. And in this case, we are especially focused on productive uses. This means that we want to increase income generation and productivity in the regions that we are working in. So due to the high risk profile of this kind of operation, the European Union gives us guarantees and technical assistance resources. FONPRODE is giving almost 30 million euros in subordinated loans. And we have already launched the request for proposal, and it has been a success. We have received 150 applications for 600 million of funding, and also 30 million of technical assistance. So we are right now conducting our due diligence process, and well, it is true that we have conceived this first program as a pilot program, and we wanted to prove if this financial scheme worked. And as I have told you, this program works, and it attracts private investors, And that is why in the future, in the next months, we are going to present a new program, which is called SOL program. It's Sustainable Off-Grid Lighting Program. And we are expecting new applications when we have the approval of the European Union. Regarding the lessons learned, we can say two main things that we have seen is that we have received a lot of projects still in early stages, and we have learned that we need to give more technical assistance and resources to finance sustainability studies, social studies. Well, the projects that we have received have to be more well-developed and mature. So that is why in our next stage in SOL program, we are working to have more technical assistance resources to help these projects to go to a mature phase. The second thing that we have seen is that in some of the countries that we are working in, there is no well predefined strategies. So we need to develop the legal frameworks of the countries that we are working in order to boost this kind of projects in the region. So we are planning to give more technical assistance in order to develop these projects. So that is our 2 lessons learned, and I think I can go to the next participant.
Thank you, Virginia.
Thank you very much. So first of all, it's a pleasure to be here. I think this is my second sort of physical event, and I'm super excited to see people and interact with people. I understand this is also a hybrid event, so a big hi to all the people on the other side of the screens, and hopefully next time you can make it here as well. I work at the African Development Bank. It's the leading development financial institution in the continent. AfDB has historically been a big partner in the energy sector, funding mostly large-scale infrastructure, transmission and distribution, generation, conventional, increasingly renewables, and increasingly private sector. I guess with our new strategy in 2016, we put SDG 7 at the heart of what we want to achieve for the continent. So universal access by 2030, and that really pushed us out of the comfort zone, and we really had to think hard about how to provide more financing and support more businesses in the energy access space, how to really push the electrification agenda. In that regard, we've put a number of financial instruments in place. I'm not going to bore you with the acronyms and the names of the programs, but we do have technical assistance grants, both for the public sector enabling environment, but also for private sector for project preparation. We have some concessional debt facilities for blending with commercial capital. We're investing equity through various commercial funds and pushing them increasingly to deploy more capital to the energy access space. We also have some guarantee programs targeting the energy access sector. So we have a number of initiatives and instruments in place. Having said that, we are finding it harder than anticipated to deploy this money, and this is where the lessons learned come in. I think number one is that we're seeing that a lot of the energy access business models are still not quite mature yet. I think we probably jumped the gun some years back saying, look, these projects are viable, they're bankable, but the reality is not quite that. We're seeing various businesses that still struggle with heavy cost structures. We're seeing same or other businesses that are struggling with the revenue side, collecting revenue, ensuring that the demand is there, expanding their client base, and this is creating challenges for raising financing. And certainly we've seen the vulnerabilities through the COVID crisis. The other issue we're seeing is that there's still very limited equity. So a lot of these businesses are fairly new. Most of them are, I would say, are undercapitalized. And when you want to raise debt, you know, a lot of the lenders will ask you to bring some equity, to show some equity, to show a strong balance sheet. And this is not the reality of a lot of the energy access businesses. So we're trying to really, as I mentioned earlier, trying to nudge our private equity funds to really provide more capital in this space, but this is still a challenge. Then if you do overcome that hurdle, you should be raising debt in local currency. And I think Per will probably share more wisdom in this regard. But this is very hard. You know, businesses are borrowing in dollars or euros, but collecting revenues in local currencies. We've seen again with COVID, you know, the volatility in the currencies, and we've seen a lot of businesses hurting because of this issue. My last 2 points, one is on scale. Again, we need to see more, you know, portfolios of projects rather than individual projects. We need to see that aggregation taking place either at a country level or at the sort of corporate level. And we're also trying to nudge the market in that direction. And finally, I think one word on subsidies. I think if there is a time when subsidies are needed, I think now is the time. I think everyone is feeling the pain. You know, if you stack up on top of all these challenges that I've just mentioned, you know, all the disruptions that we see in the market, you know, if there is not more subsidies, subsidized capital, more patient capital, I think it's going to be very hard for the sector to sort of ride out of the storm and for a lot of businesses to stay afloat. Thank you.
Thank you.
Thanks, João. Good morning, good afternoon, everyone, and welcome from my side as well to this session. So I'm Steven Fleurus. I'm the CFO of ENGIE Energy Access. So ENGIE Energy Access is actually created in 2020. So we exist about 2 years, and it's actually the combination of 3 companies. So it's a combination of Power Corner, which was still is the mini grid company, which was created by ENGIE itself. Then on the solar home space, you have the Phoenix acquisition that ENGIE did in 2018. And we did also a second acquisition with Mobisol in 2019, 2020. So these 3 companies have been put together and are now consisting of ENGIE Energy Access. So they are managed by one team, and we have a holistic approach actually in terms of the business model. So we think that putting these 2 activities together will be beneficial for both of them. So for the moment, we are active in 9 countries in Africa. We are about 1,800 people, of which 1,700 are based actually in Africa. So we have about 60, 70 in Europe and then 30 in China. In terms of products that we offer, as I said, it's solar home systems and mini grids. So we have a range that ranges from 10 watts, which is a small kit that we have in our gamma, up to 600 kilowatts. So that's the biggest mini grid we have for the moment in the Lolwe Island in Uganda. So for the moment, we are impacting about 7.5 million lives, and it's our mission to increase that up to 20 million by 2025. So in order to do that, we need to further scale up. We need to further mobilize money. And then I come to the main lessons learned, what we have done for the moment. So in our approach, we have mobilized commercial funds, of course, equity on one side. We also have partners in some of our projects that also have put in some equity. At the same time, we also mobilized external debt. So on the DFI side, maybe you have seen the press release last week that we signed a contract with EIB, so the European Investment Bank for Benin. So we are looking more and more in these type of transactions, and also at the same time trying to secure local currency funding, but then more from commercial banks. So that's still a challenge, but something we work towards. So in terms of lessons learned, so there are 2 things for me. So one is indeed, if you want to do this scale up and impact more lives, it's a capital incentive business. So on the SHS side, we need the funds for the working capital purposes. On the mini grid side, it's as CapEx, so it's an infrastructure fund. And as you say, João, we need more, and indeed also patient capital. It takes time to get these projects on the ground, to make them work. So I think that's key. At the same time, also the grants that you mentioned, we are indeed in difficult times. So that's also certainly an important point for us. And secondly, we need, on the other side, projects that are sustainable. So we can raise money, but if it's to invest in projects that are not meaningful, that are not sustainable, it doesn't attract much investors either. So we worked a lot in the last 2 years to make sure that our projects are sustainable on the SHS side. So we put a lot of focus on managing the credit risks, which is still one of the main risks on the SHS side. So making sure that our credit portfolio is of good quality, that we engage a lot with customers, in each of the countries. And at the same time, also focus a lot on pricing to make sure that we offer the best price to each customer. So that are for us the two main key learnings of the last couple of years.
Thanks.
Hi, everyone. I'm Kisa. I work with Okra Solar. So at Okra Solar, we're evolving the energy access sector with our technology solution, which is the Okra Mesh Grid. The Okra Mesh Grid is high power solar home systems that can be interconnected together to share energy generation and energy storage. So our model is B2B. Our customers are project developers who are actively going out and installing Okra Mesh Grids in Nigeria and in Haiti. So our customers have a substantial problem in securing funding. And so we have a big focus on taking a more hands-on approach with our customers to make sure that they have the funding that they need, specifically for development and construction. We see this as kind of the biggest gap. So that leads into the lessons learned and how we play a more active role in supporting capital inflow into the development of distributed renewable energy projects. The first is through trying to solve this gap in upfront capital required. So for example, our customers in Nigeria, they receive a cost per connection subsidy, but they only receive this subsidy once they've actually developed and commissioned the project. They have to procure the equipment upfront and spend everything on development, installation, et cetera, which really creates this high upfront capital requirement where there doesn't necessarily need to be. So one way that we're actively addressing this is by, we've been working with EDFI Electrify to secure working capital facilities so that we can offer better payment terms to our customers. And they can basically procure our equipment on financing and then pay for the remainder of the equipment after they've received the subsidy. So that reduces that upfront requirement and increases the kind of size of the projects that they can develop. The other main challenge or lesson that we've seen in the market is our customers' resource that they have to actually interact with investors and go through the fundraising process. These companies are in a really challenging business context, and just getting equipment through customs and on the ground and installed is a super involved process. And aside from large multinational companies, a lot of them who are really pushing the boundaries in and innovating in the market don't have the resources that they need to actually be interacting with investors and raising capital. We've experienced this on kind of the other side because we've in entering the Nigerian market, we had a lot of support from Allon, and in our obtaining the EDFI, working with EDFI, we had a lot of support from GET.invest. So it can be really a game changer to have that kind of support when you're securing funding. And we try to do a really active role with our customers and helping them to make sure that they have the capital they need. So for example, in Haiti, while our partner was on the ground deploying the systems in a really tough political context, we made sure that we were getting the data that was coming out of the pilot and connecting that right into investors to make sure that we were working with the developer to enable them to secure funding for scale. So that's something that we try to be really proactive in.
Thanks. Hi, everyone. I'm Nico Tyabji with SunFunder. We provide debt financing to distributed clean energy companies. we're almost exactly 10 years old. So 10 years ago, we had the first kind of pioneer solar home system companies that were starting to find business models that worked and scale, and they could not get loans for expanding their businesses. And our founders saw that and started a crowdfunding platform. And 10 years later, we've financed nearly 60 of these companies, impacted a bit over 10 million people through these financings, and have really been kind of, I guess, dedicated to this sector, wanting to provide the scalable financing. We very quickly moved on from crowdfunding to different blended finance models, currently onto our fourth such model. And I guess in the context of unlocking commercial capital, really, we've always had that vision of blended finance structures being about delivering long-term scalable commercial financing unlocked through the blended finance structures with the partnership between public and private investors, different kinds of investors. So I guess on one hand, the experience of that has been relatively slow in the sector. I think all those of us who've worked on blended finance would probably agree. We haven't seen this great influx of commercial capital into the funds, but it's not through want of trying. I think we've learned a few things along the way. The other thing to say, kind of what SunFunder is doing now in that context, is we are launching a larger scale vehicle, a $500 million fund. Half of that amount will be institutional private capital. And maybe one of the lessons specifically around the blended finance structures at the very high level is just needing to have built the track record, both for SunFunder as a fund manager, but also for the sector as a whole, to provide the kind of data points, the kind of opportunities for those scale tickets. The other is just the size of the investments required. So, you know, you cannot be looking at kind of $5 to $10 million tickets for the super senior layer for institutional investors. And that's partly why we've gone for a larger fund structure and are seeing more appetite for that now. The other side of the blended finance, and speaking a little to the point that Kisa just made around the attention or the time that entrepreneurs have to close investment, we've done kind of, I guess, blending at the transaction level, if you like. A good example would be a facility we closed with Culture last year, which was made up of a fund initially created by João and the African Development Bank, Fei Ojef, and some other kind of impact investors, but also with Triodos, a private sustainable investor from the Netherlands. So that's an example of blending, working to get commercial investment in at the transaction rather than the fund level, and became I think the largest investment or debt investment for the productive use sector today. And crucially, what that can kind of achieve for the companies as well is removing some of the fundraising burden, because they only have to deal with one set of annoying investors who's leading that syndicate. Maybe just the third thing on the kind of the private capital side is I should really, or we will be starting to introduce ourselves as Moreover SunFunder henceforth, because we have just announced that SunFunder has been acquired by Moreover. It's very exciting for us, but I think also sort of genuinely for the sector, because Moreover is a 100% sustainability focused French impact investor with around $30 billion AUM, and part of a much larger finance group of about 1.4 trillion AUM. And so this represents really private commercial capital with an impact focus in the case of Moreover, looking at our sector, learning about it, believing in it, wanting to do more in it. And that's what Moreover SunFunder will be doing. And so very much looking forward to working with all of us for the next decade. I guess, should I go into some lessons learned or second round?
Yeah, if you give that briefly and then we go, because I've got some other questions for you as well.
Yeah, sure. Yeah, I think I mentioned the track record and scale and that being kind of fundamental to this journey. The other side maybe is just to say the capital is there. So we've seen, I mean, particularly in the last 2 to 3 years, this kind of overwhelming interest from large private investors in the sector that simply wasn't there before. I think it's been associated with a general interest in reallocating to ESG, environment, social, and governance related investments, and of course also climate investments. So as an example, the fund I mentioned, the $500 million facility that we're working to launch was shortlisted by the Net Zero Asset Owners Alliance, convened by the UN, and they themselves represent over $10 trillion of institutional capital that is committed to getting to net zero. So that's it. We're not there yet, but there is that kind of that interest and a surge of supply. And I think it's on all of us to figure out how to give that supply some more demand. And then the final lesson I would say is just in terms of the kind of sector level partnerships. I mean, I think one of my colleagues mentioned the ecosystem approach. We've certainly at different times worked with everyone on this panel and hope to with Kisa soon. But I think this is a very unique sector of having so many different actors all coming together and trying to make things happen really for the same impact objectives. And we've been, very humbled and grateful for all of those partnerships. And again, we just think that's going to be essential for the next stage of scale.
Thank you all. And we're a bit lengthy introductions, but I think it was really worth it, because what I was looking for was, are we going to have a panel that is picking up where we left 2-3 years ago? But if you listen to what's been said, I think a lot of has been happened in between, and I would like to focus a bit on that. So maybe we can start with ENGIE first, because you were saying, yeah, you started as a merged company with all the synergies in 2020, where you've put everything really together. Can you tell us a bit more on how putting those companies together and how synergies have they led also to easier commercial finance raises, or do you have to raise still apart for the mini grid sector and for the solar home system part, or how does that work with ENGIE?
Okay, thanks for the question. Indeed, we have gone the last 2 years through this integration, and we can now say that we are fully integrated. So it actually means that the different teams have been put together as well. So for finance, for instance, you people before were looking at mini grids and SHS, they are now together. Also from an operational perspective, commercial teams, all of them have been put into one team. And the reason for that is actually that we tried the mini grids benefit from the experience that we had on the SHS side, and certainly on the commercial side. I think there we have very good successes, and these wins we try to transform or translate them into the mini grid space. So to make sure that also on the mini grid side we can have this as a success in terms of operational and commercial activities. Another thing that we do actually through this is try to optimize the size of the mini grid. So not everybody can, if you solarize a village through a mini grid, what you try to do is actually try to solarize the village. But actually this is not optimal from, I would say, a CapEx perspective. So we try to combine the two. So where we put our mini grids, so the people closer to the mini grids will be electrified through the mini grid, but then the people further away from the mini grid, they will be served with solar home systems. So in that combination, we try to find the optimal point in terms of CapEx invested, and at the same time, the OpEx is needed and the revenues that we can get from these type of projects. Also, a big risk that we have on the mini grid side is the demand risk. So it's one of the most difficult things to assess how this evolves over time. So what we also now doing is before the arrival of the mini grid, actually already sell our solar home systems. So in this way, we have a better idea of the demand risk or the credit risk actually of the customers. So it enables as well to better assess again the mini grid and to benefit from that situation. So I think that more the key learnings or the key things of putting the two activities together.
Thanks. And then if you go, Kisa, if you could also give your thoughts about how you as a B2B player actually in between many of the financiers here and maybe many of the actual project developers here in the audience, how is your role exactly in de-risking, helping scale up the sector, but also for yourself? Does that give you opportunities for fundraising yourself, or is it difficult because you have such a specific place in the value chain?
Yeah, great question. So I'd say there's two aspects of our technology which really help to kind of de-risk these types of projects for investors. The first is that we have a really comprehensive software platform that project developers can use to really understand a lot about what's going on in their grids and also operate and maintain their grids on an ongoing basis. So the platform allows them to do appliance financing, understand energy generation and overall grid health. So this helps project developers, but also investors to have a really clear picture on what's going on with their active investments and then to evaluate a new investment with an existing developer. And then another aspect of the technology side is for mesh grids to be successful, there's basically a larger pool of different communities that they're applicable to. So whereas for a mini grid, a community of maybe 1,000 households or more would be what's necessary to have a successful project. Mesh grids are flexible and can be applied in a bunch of different ways. So for example, we have a customer that had secured financing for a project and then found out later that that community had already basically committed to another developer. And they were able to use our equipment because it was more flexible and apply it to a different community and kind of successfully develop the project. So it removes a bit of that really site-dependent risk that's inherent in mini grids. And then I'd say more generally, one thing or one value that we do provide is just as a little bit of a third party. We have a vested interest in partnering with developers that are going to be successful and projects and contexts that make sense and are going to be financially viable in the long term. And so we can talk to investors and talk to developers and come from a little bit more of an objective perspective. Obviously, we have a vested interest in our projects, but that's kind of the role that we try to play. And then lastly, on the raising money side, I'd say as a technology provider, it puts us in a bit of a unique position to actually have more success in raising money. So we just closed a $2 million round in January. And one thing that investors really like is that we are neither here nor there. And we're really kind of providing an innovative tech solution. So yeah.
That's clear. Thank you. Maybe João, can I ask you a question? Because if indeed you look at the 2 years in between, obviously a lot has happened, but still also today, I think, not just with COVID, but with Ukraine and with logistical problems, we are talking about de-risking the finance in the sector, but I think not just the sector, but the whole world has become more riskier. How do you see that and how do you treat that at African Development Bank? And maybe give us some insights in the thoughts and the discussions that are happening.
Interesting question. Yes, I think that's probably one of the issues that is keeping us up at night these days. We've started with concerns around the sustainability of the energy access space. A few years ago, I think Nico and I think everyone here probably was involved in those early discussions about how to support the sector through the COVID pandemic. But the reality is that the entire sector is feeling the pinch. We're seeing utility scale projects that are not closing. because they've locked in tariffs that are now sort of unsustainable from an economic standpoint and financial standpoint, obviously. We're seeing utilities going deeper in the red in terms of their solvency. So it's pretty dramatic, I must say, especially now with the Ukraine war. I guess our intervention is twofold. I think one, we need to keep working through the long-term issues, and some of them I've highlighted earlier. So hopefully the pandemic will eventually go away. So we really need to keep playing our market development role. So we're both, as AfDB has a very unique position, because we work both with the public sector and with the private sector. So we have a very unique market development mandate. We're working with government on sensitizing them about, the various issues, including, policy regulations, bankability issues of energy access businesses. We're providing them with technical assistance and technical support to address some of these bottlenecks, design scale-up programs. But we're also working with the private sector and provide some sort of seed financing and concessional financing for them to experiment with new business models to really sort of address some of these difficult challenges, especially on the demand side. If we're talking about mini grids, how to sort of stimulate more productive use around mini grids, for example. So we're doing that. We're both with the public and the private, and also with working with financiers, both on the capital markets and local commercial banks, to really understand the space and providing blended finance solutions, hopefully in the form of guarantees, primarily really to de-risk and bring more local currency to the space, and certainly working with ARE and other industry organizations to keep sort of the word out, to keep knowledge flowing on what works and what doesn't. Specifically on the challenges that we're seeing, we launched in 2020 what we call the COVID-19 off-grid recovery platform. So this was a blended finance platform to provide concessional, soft, patient, risk-tolerant capital to energy access businesses through the pandemic. I think we've deployed almost all of it for the first shot. So we're putting in $20 million concessional to be blended with 30 million from 3 commercial lenders in the market. We're talking about the Off-Grid Energy Access Fund managed by Lions Head, Triple Jump, the EEGF and SEMA funds. I think most of the capital has been committed to about 20 businesses. And we're talking about businesses on the smaller end, right? The ones that are struggling the most. We're actually about to come back with the top up to this facility, because yes, COVID is still there, but maybe COVID is less of an issue, but some of the fundamental issues around supply chain disruptions and increasing cost of financing and interest rates are on the up, as everyone knows. So we'll keep pumping. I wouldn't like to call it emergency money, but some sort of some kind of like concessional liquidity into the market to help the businesses ride the crisis, and hopefully we'll come out stronger. Everyone will learn. Everyone will sort of really fine-tune their businesses, and will come out stronger and in a better position to sort of then bring in the big investors to the sector. Thank you.
Thank you, João. And when you mentioned increasing interest rates, I immediately have to think also of you, Per, because that has an influence also, obviously, on exchange rates. How volatile is that right now, and how easy is it to really de-risk with your local currency solutions? As easy as before or more challenging now? Can you tell a bit more, and also how you see your role in that?
Yeah, good point. I think African currencies have been very, very volatile over the decades, as many of you know, but and COVID was another example of currency volatility across the board, with dollar interest rates on the rise, with all the crisis that is emerging. You can wait for the dollar to increase in value and consequently local currencies to decrease in value. So volatility is likely to increase. So the risk of borrowing in debt and the risk of financing the energy access sector with dollars is only going to increase. Our message, of course, is that funding in dollars, funding the energy sector in dollars is the wrong choice. Most economists and risk managers and CFOs would agree with that general statement. And local currency financing is the right thing to do. However, and this is maybe one of our key lessons learned, we also recognize that even while that logic may be true, especially when interest rates in local currency become a lot higher than a dollar alternative, it becomes very, very difficult for an individual CFO, for an individual project to make the right choice. And that's potentially a big problem. What you saw in the microfinance industry 20 years ago, when that started to emerge, a lot of individual businesses thought, oh, the dollar loan looks better, and they make the choice for a dollar loan. But if everybody does that, you're also creating a sector which is much, much more vulnerable, much more exposed to exogenous shocks. And if a crisis then happens, it affects the entire sector with potentially very damaging consequences. The same could happen in the energy access sector. And that's why it's not a good thing if everybody makes the choice for dollars, even though for an individual mini grid developer or a solar home systems business, that might be the right choice and a legitimate choice. You know, gamble that the dollar is going to be the cheaper loan, hoping that the local currency is not going to depreciate too much. To discourage borrowers doing and making those choices, what we have done in the past year, what we're looking to expand in the years ahead, is to channel donor subsidies into our product, allowing us to reduce the cost of hedging, which will then translate to reduced cost of local currency borrowing. And that will encourage, we hope and expect, individual borrowers to choose for dollar debt rather than local currency debt. Pardon me, for choose for local currency debt rather than dollar debt. Because if you take 2-3% of that difference, you're really reducing the upside potential of taking the risk. We are, in terms of partnerships, we have a program running with the European Union. We are now in the process of developing another program which will be more, which will be bigger, more scalability, which should stick around for a number of years. We've recently engaged Open Capital Partners as our implementing partner. So we'll be preparing that facility. The European Union is a likely donor, but we're also going to talk to other donors. And hopefully with that initiative coming into the market early next year, we will be able to encourage much more businesses to opt for local currency, and by doing so build a more stronger, resilient sector, less exposed to currency volatility, and hopefully that will, you know, help accelerate rollout and achieving the development goals by 2030.
Thank you. I think that sounds exciting, and I also see your neighbor, Virginia. You have been nodding along with both your neighbors, actually. So I think you recognize a lot of what has been said. And in that respect, I think it's even greater that you have decided to turn your pilot project into a real, the SOL program.
Yep.
Can you tell us a bit of what were the main drivers, why you have decided to actually take that step forward in these difficult situations?
Okay, thank you. Yes. Well, it is true that we are trying to expand our existing program, the renewable energy program in Sub-Saharan Africa, into SOL program. Well, we are going to present this project to the European Union in the next month. And this project is going to learn from the lessons that we have learned in the past program, mainly two things. The first one is that we need more mature projects. So we are going to work in our first phase of this program to provide technical assistance resources to projects in Sub-Saharan Africa in early stages, for example, with social and environmental studies, feasibility studies, and this kind of help. The other thing that we have seen is that we need to create, before everything, an appropriate business climate and a legal framework that is going to allow private investors to come into this sector. And that is why in our first phase, we are also going to provide technical assistance resources to local partners and local entities in the region through technical assistance resources. So we are interested on working side by side with local governments and public entities in Africa. The second phase of our project is going to be pretty the same as the first project that we have in Africa. We are going to use the financial resources from the Spanish Cooperation Agency, which is going to be backed by the European ESD program through guarantees. And in order to continue, we are going to try to benefit from the technical assistance resources that we have provided to these projects in the early stages. So the next projects will arrive in a more mature phase. And we believe that as we have proved that this financial scheme attracts private investors and sponsors, we are going to build a very strong pipeline of future projects in Africa. But we don't want to stop there. And the third phase of this project, of this program, is going to be the one where we are going to create investment funds for private investors to invest in the projects that we have already developed. And what we are looking from the new partners that we are going to receive in our applications is that we need projects that take into account that the projects don't end with the construction phase. We have to go a little bit beyond, and we are looking for projects that have what we call the complete package. Construction, but also projects who have taken into account the real needs of their target beneficiaries. And also, we want to implement these projects in Africa, but also to promote economic development. And for that, for example, we are thinking of providing microfinance loans to entrepreneurs or to build business centers in the regions where these projects are. So we are, we think that this project is going to be very useful because it has been developed through the lessons learned that we have told you today. And we hope that maybe next year we are going to come back and tell you a little bit more about this program. So I'll be here today. If someone wants to talk about this program, I will be happy to do that. So thank you.
Thank you, Virginia. And I kept you till last, Nico, so that gives me a bit of a chance to actually practice Mirova SunFunder. But I think, first of all, congratulations indeed with 10 years SunFunder, and now with this new start. I remember 10 years ago, indeed, that you also had quite a different risk profile than you have now, starting when the sector also had a different risk profile and a different need. If you look forward now also with this new merger, how do you think, will that change? Will that be the same? What can people expect from Mirova SunFunder the coming years, and especially like the people who are sitting next to you who will need your money most?
Well, yes, thank you. I don't know if this is on, maybe not. It is, great. Thanks, Daphne. And I guess the first thing to say is really that SunFunder is very much committed to this sector, is not intending to change focus. All of our kind of immediate priorities stay the same. We have our current funds we're investing out of, and I mentioned the new scale fund that we're working towards launching, which predates the acquisition as well, and was very much there with the intention of being able to provide the kind of scale financing that some of the sector needs, and it's very much a pipeline-driven fund. I think it's certainly true that SunFunder's own ticket sizes have changed a lot over the years. I mean, I think we first started working together when you were at Dune Foundation, and SunFunder was doing loans even less than $100,000. And times were very different then. And that was a wonderful experience. And I think we all at SunFunder know that smaller ticket size debt is still very much needed, both by earlier stage companies, but particularly by local entrepreneurs. I think it's a nut that the sector as a whole has not cracked. We're very supportive of initiatives to make sure that the smaller ticket debt is available. Something we are doing with a new fund is a TA facility. We've never actually run a kind of formalized TA facility, but have made kind of countless, TA in all but name over the years in terms of working with earlier stage companies, the additional kind of handholding and frankly, the higher transaction costs that comes with that. So all that to say, no, the intention is very much to be here for the sector. That's very much Morova's intention as well. Essentially, Morova SunFunder will be building out an emerging markets platform of energy transition investments. So that includes off-grid, but also the mini-grids, CNI, et cetera, et cetera. I think it also opens up opportunities in other areas as well. So as a kind of strategic fit, which is really where this acquisition came about, Morova have been doing very interesting work for the last decade. They're actually only a decade old themselves, a slightly different startup story, having emerged from Natixis Investment Management with a rather larger pool of startup capital than SunFunder had in the early days. But essentially, they've played a very pioneering role in the European energy transition, but also in emerging markets with natural capital funds, and again, have played quite a pioneering role there. So there's just a very kind of natural fit in terms of how we can build out together in new areas as well. But look, our team is very much staying in place. Our founders are committed to the long run. So I guess the main message to everyone we've been working with is that we're very much kind of here to stay and do more together and look forward to that.
Thank you. I'm looking at the back whether this is a positive note that we need to stop at or whether there's room for questions. No, I see unfortunately no questions, but the good thing is that lunch is finally waiting. We've tried to keep this a bit shorter than planned originally because trying to make up a bit for the lost time, but our panelists and myself, we will be here. So if you do have any questions, don't hesitate. You can always ask to any of us. More than happy to take this discussion further. And we probably will, and I hope we don't have to wait another 3 years, but that we can talk about this pretty soon again. Thank you all for being here, and thanks for the panelists. Thank you.